Hot damn, the Federal Reserve, through their mouthpiece, the Wall Street Journal, is starting to talk about the Fed pivot. Yeah, literally. But their concerns are that if they talk about the pivot, something like this will start happening. Okay, this is just a microcosm example, but take a look at this. This morning, NASDAQ futures were falling, and we were basically trending down all morning, and all of a sudden we get this spike in futures. And why is that? Is it because Snapchat is down 25%? Because their advertising revenue is plummeting and their growth is like flat? Gee, that wasn't a surprise. American Express is potentially going to lose more money on credit cards than expected. That coming in as a little bit of a surprise. And Elon Musk telling us that the recession that we're going to go through right now, or are going through, might last until the spring of 2024. I don't know. But the big news right now is the Fed trying to figure out how they start massaging a pivot into the market. That's right. See, remember, the Federal Reserve acts in a really weird and funny way. They like to do what the market tells them to do. Now, I say tells them with air quotes because the Fed likes to give the markets hints or kind of push markets into the direction that the Fed is going, and then wants markets to price in what the Fed is going to do, and then the Fed does it with as little risk to financial stability as possible. They don't like to just rug pull markets, they like to bleed markets, because if things are bleeding out, then you could kind of start seeing if things are slowly breaking rather than suddenly breaking like you had in the United Kingdom. So, this morning, the Wall Street Journal, just about 20 minutes ago, posted an article and started talking about the Federal Reserve working on their massaging message for how are we going to potentially raise interest rates only by 50 basis points in December without triggering a market rally. And finally, the Wall Street Journal, again, sort of the unofficial mouthpiece of the Fed, and we say that because, remember, this summer, the Fed was supposed to go for a 50 BP hike. We got a bad inflation report, and then like days before, all of a sudden, someone in the media happens to get a text message suggesting the Fed might go 75. Then markets crash, and the Fed ends up going 75. Right? So you kind of see how the game gets played. So these articles kind of previewing what's going on at the Fed unofficially are kind of like the Fed's newspaper. And in the Fed's newspaper today, they're warning us that, hey, look, last time we started this whole like pause and pivot idea, markets rallied. That was in late July and early August. We had almost an entirely green August where it's just up. It was great. It was wonderful. People were spending money. People were buying courses on building your wealth, which you really should do in every market that you're in. People were buying life insurance at metkevin.com/life. They were signing up for 12 free stocks at Webull at metkevin.com/Webull. People were happy. Markets were going up. But Jerome Powell wasn't happy. So what happened? Jerome Powell had to come out and talk markets down again. And that's exactly what the Fed talked about in this article. In fact, well, when I say the Fed talked about, the Wall Street Journal talked about, what they start talking about is how is the Fed going to be able to signal a potential smaller Fed funds increase in December without the risk of a market rally. Literally their words in the Wall Street Journal. So the Wall Street Journal's words, we'll stick with that. They might do this through their newly updated summary of economic projections, which could potentially talk markets down for the rest of the year in 2023, which is quite remarkable because in 2023, we were kind of all hoping that we would hit some kind of bottom of this pain and get out of the pain. But now it looks like, no, it's entirely possible that the pain could actually last through 2023, especially as Elon Musk mentions this morning, the recession could last until 2024. And remember, in the Tesla earnings call, Elon Musk made it clear that one of the reasons they're not doing Tesla stock buybacks now at such cheap levels is because they're preparing for what if there's a really nasty recession in 2023, rather than just sort of your garden variety, everyday run-of-the-mill recession. Combine this with the fact that treasury yields are going absolutely bonkers, and you have what actually makes for a relatively tight set of financial conditions. Look at the 10-year treasury yield. I mean, I've been freaking out about the Treasury yield near 4% because that means mortgage rates around 7.5%. Well, now it's 4.3% on the 10-year. That means we're probably starting to knock on the door of 8% mortgage rates for real estate, which in the short term is going to be absolutely glorious as it creates a housing correction for house hack, because we're going to be able to buy the dip really freaking cheap, which is great because you buy cash, wait for the pain to go away, you wait a couple of years, and then you refinance when rates come down and you keep buying. It's simple. The point is you want to buy the bottom. Anyway, this is a very tight set of financial conditions. And what's weird is they keep going up. In the last 3 days, even after Liz Truss resigned, we've seen the Treasury yield only trend up. Earnings are pushing the Treasury yield up. It's almost like earnings are telling the Federal Reserve and the bond market that, hey, this just isn't bad enough. This isn't the earnings recession we were expecting yet. It's just not bad enough, with the exception of a company like Snap. We need even tighter financial conditions. And so next up, we obviously at this point have a 75 basis point hike priced in for November 2nd. November 2nd, folks, is in less than 2 weeks. So we've got another Fed meeting already in less than 2 weeks. How weird is that? And then 6 weeks thereafter, we get the Christmas rate hike, which we hope will be a little bit of a discount at 0.5. But even though that might signal some form of softening, you already have the Federal Reserve worried about, we don't want to signal a market rally. Now, you do have some folks over at the Fed who are saying, look, we got to be careful. We can't hike so aggressively anymore. Maybe we'll quantitatively tighten a little bit less, is an idea that's floating around now. Maybe we're being a little too aggressive because we have to wait for some of the lag of monetary policy to take effect because we don't want to overcorrect. But then you have others like Neil Kashkari who say things like, well, but can we get services inflation down by pausing on rate hikes? So you have a real debate at the Fed in terms of rate trajectory. Remember, folks, this is the Federal Reserve's dot plot. And what you notice is you have a consensus for 2022. That's pretty much already in the bag. Let's go 75 and 50 or 75-75. That doesn't so much matter. 2023, we mostly right now have a consensus to the upside. However, this is likely in the December summary of economic projections to trend up because the Federal Reserve is still not seeing progress on inflation. And the most important report that we're likely to get coming soon here is not actually going to have to do with what the market thinks about rates. It's going to be the employment cost indicator. This is the employment cost indicator chart, which has been skyrocketing. It comes out every single quarter. It's a quarterly release by the Bureau of Labor Statistics. It's basically CPI for labor. And next report is a week from today, October 28th. And it could be dirty, which could lead to a 75-75 as the Fed's worried about a wage price spiral in 2023. And that could actually lead to consistency of the 2024 numbers moving up. And this is where the uncertainty lies. Uncertainty lies in 2024. In other words, how long do we have to keep those rates up? And what if all of these folks start adjusting rates to here and markets have to adjust down because pain is going to last a lot longer than we thought? Look, I hate to say it, but I've said regularly, 2022 is going to suck. No way in hell could you have asked me, hey, in January or March of this year, hey, you think 2023 is going to be better? I'd be like, hell yeah. Well, now it's like, maybe not. Maybe the recession will keep going. Maybe it'll even get worse. And the Fed is debating exactly that. And that's scary. But in the meantime, stay in the course and playing Mario Kart. See you in the next one, folks. Good luck.